On the 11th of March 2026, the Indian stock market experienced a significant downturn. The session was characterized by a decisive risk-off sentiment among investors. Earlier signs of market recovery could not be sustained. This indicates a notable shift in overall investor sentiment. Optimism previously observed has now transitioned to caution. This change in sentiment is primarily driven by various external factors. The Nifty 50 index began the day with an opening value of 24,231.85. Early trading saw a brief surge, pushing the index to an intraday high near 24,299. This initial upward movement, however, proved to be unsustainable. Throughout the trading session, the Nifty 50 experienced persistent selling pressure. This consistent selling activity ultimately dragged the index downwards. The market demonstrated a clear lack of sustained buying interest during the day. The Nifty 50 index concluded the trading day at 23,866.85. This closing value represents a significant decline from its previous position. The index experienced a sharp fall of 394.75 points during the session. This point drop translates to a percentage decrease of 1.63% for the day. The closing metrics indicate a substantial negative movement in the market. The BSE Sensex experienced a significant decline in its recent trading session. The index dropped by 1,342.27 points, reflecting a substantial market correction. This point decrease translates to a percentage decline of 1.72%. The closing value for the BSE Sensex was recorded at 76,863.71. This movement indicates a broad-based downturn across the market. Such parallel declines confirm widespread negative sentiment among investors. The session's market tone was primarily shaped by global developments. Domestic triggers played a secondary role in influencing market sentiment. This indicates a significant external influence on the Indian market's performance. Global factors exerted a stronger impact than internal economic conditions. Market dynamics during this period were largely driven by international events. Geopolitical tensions are escalating in West Asia, becoming a significant global macro concern. Such instability refers to political and economic uncertainty in a region. These tensions often trigger risk aversion in financial markets. Risk aversion leads investors to seek safer assets, shunning volatile investments. This global market reaction reflects the interconnectedness of international economies. Crude oil prices recently experienced sharp volatility. This fluctuation is often linked to geopolitical concerns and global events. Such price instability has significant impacts on the global economy. It particularly affects nations heavily reliant on oil imports. The cost of energy directly influences production expenses and consumer prices. Therefore, crude oil price volatility is a critical factor for economic stability. Geopolitical tensions contribute to economic instability and market uncertainty. Surging crude oil prices are a direct consequence of these global tensions. Higher energy costs increase production and transportation expenses for businesses. These increased costs are often passed on to consumers, leading to inflation. Various economic factors can collectively raise alarms regarding broader macro stability. A key concern arises when inflation risks begin to increase within an economy. Central banks typically respond to rising inflation by implementing policy tightening measures. Such policy tightening can, in turn, negatively affect overall economic growth prospects. The Strait of Hormuz is a vital choke point for global oil shipments. It connects the Persian Gulf with the Arabian Sea, facilitating a significant portion of the world's oil trade. Concerns over potential disruptions in this strait directly influence global oil supply expectations. Such fears can lead to a surge in oil prices due to perceived scarcity. The strait's strategic importance makes it a key factor in international energy markets. Oil importing economies, such as India, face significant challenges from rising crude oil prices. These nations are heavily dependent on imported oil to meet their energy demands. This reliance makes them particularly susceptible to fluctuations in the global oil market. Global supply shocks, such as disruptions in production or geopolitical events, directly impact these economies. Increases in crude prices can lead to higher import bills, affecting trade balances and currency values. Such price volatility creates economic anxiety and can trigger inflationary pressures within these countries. India's economy is significantly impacted by global crude oil prices. Rising crude prices directly increase the nation's import bill for oil. This necessitates a greater expenditure of foreign currency to acquire the same volume of oil. The increased outflow of foreign exchange negatively affects India's balance of payments. Consequently, fluctuations in crude prices are a critical factor for India's economic stability. An increased import bill signifies a higher demand for foreign currency to pay for goods and services from abroad. This heightened demand for foreign currency places significant pressure on the Indian rupee. Consequently, the rupee weakens, meaning it loses value against major international currencies. A weaker rupee makes imported goods and services more expensive for domestic consumers and businesses. This rise in import costs can directly contribute to and fuel domestic inflation within the economy. A higher import bill contributes to increased domestic inflation. A weaker rupee further exacerbates inflationary pressures. This combined effect erodes the purchasing power of consumers. Such conditions often necessitate monetary policy responses from central banks. Macroeconomic factors significantly influence financial markets. These macro linkages often lead to caution in the equity market. Investors become wary when inflation pressures rise. Currency pressures also contribute to investor caution. Sectors sensitive to interest rates and economic growth are particularly affected. The Indian rupee experienced a weakening trend during the recent trading session. This depreciation was primarily driven by significant foreign fund outflows from the Indian market. A key contributing factor was the increased global demand for the US dollar. The US dollar often serves as a safe haven asset during periods of geopolitical uncertainty. Investors seek the dollar's stability when global economic or political risks rise. This shift in investor preference directly impacts emerging market currencies like the rupee. Currency weakness intensifies risk aversion among foreign investors. When local currency investments lose value relative to their home currency, investor confidence erodes. This devaluation directly impacts the profitability and security of their foreign holdings. Consequently, foreign investors are more inclined to withdraw capital to mitigate further losses. Currency weakness can lead to increased risk aversion among investors. This heightened risk aversion, in turn, amplifies declines in the equity market. A key factor is the withdrawal of foreign capital from the domestic market. Foreign capital withdrawal directly reduces the overall liquidity available in the market. This reduction in liquidity creates significant selling pressure on domestic stocks. Consequently, domestic equity prices are driven down further, exacerbating market declines. The market's sectoral pattern reflects investor sentiment and capital allocation strategies. A defensive mood indicates a shift in investor preference towards stability. Investors reallocate capital from growth-oriented sectors during periods of uncertainty. This capital is moved into sectors perceived as more stable and less volatile. Such shifts highlight risk aversion and a focus on capital preservation in the market. Financial stocks often carry significant weight within major benchmark indices. These stocks were identified as primary contributors to market downturns. Selling pressure was particularly evident in large private banks. Financial services companies also experienced substantial selling activity. This market sensitivity reflects broader macroeconomic uncertainties. Certain energy and gas-linked companies experienced an increase in stock value. Investors anticipated potential supply disruptions in global energy markets. This led to strategic capital reallocation towards perceived beneficiaries. This divergence highlights selective investment based on macro-environmental factors. Foreign institutional investors, FIIs, are significant participants in domestic financial markets. Recently, FIIs have maintained a position as net sellers in the market. This selling trend reflects broader global risk aversion among these investors. It also indicates ongoing portfolio rebalancing strategies by FIIs. Their consistent selling activity has exerted downward pressure on market indices. Domestic institutional investors play a crucial role in market stability. They actively engage in purchasing assets, providing essential liquidity to the market. This activity can partially offset selling pressure from foreign investors. Their consistent buying helps cushion market declines, preventing sharper falls. However, This support may not always be sufficient to reverse overall negative trends. It signifies a robust internal support system within the domestic financial market. The market displayed a bearish technical structure during the trading day. It opened with strong upward momentum, but ultimately closed near its lowest point. This price action indicates that sellers maintained control throughout the session. Limited buying support at higher levels suggests persistent short-term weakness. Volatility indicators, such as the India VIX index, have remained at elevated levels. High volatility signifies increased demand for hedging strategies in the market. It also reflects uncertainty regarding the near-term direction of market movements. This suggests that traders anticipate significant and rapid price swings in the market.